In this final video on accounting for inventory, we're going to be discussing lower of cost or market. At the end of an accounting period, a company is going to take a physical count of the inventory. They are going to use one of the inventory cost flow assumptions to calculate the cost of ending inventory, but the final step is going to be to apply lower of cost or market. So we're going to need to review the inventory to ensure that it is reported at the lower of cost or market. So cost is the cost that we used according to the cost flow assumption. Market is defined as replacement cost if LIFO is used, and net realizable value if one of the other three methods is used. So typically an adjusting entry is going to need to be made if market is lower than cost. The general idea here is that we don't want to have any asset reported on our balance sheet in an overstated manner, so that if the fair value of it has fallen below cost, we need to write it down. So lower of cost or market can be applied in one of three ways. You can apply it to each individual inventory item, to major categories of inventory items, or to the entire inventory. So in my example, we're going to apply it to each individual inventory item. So our example here is that Craddock Company carries three inventory items, X, Y, and Z, and the following information pertains to the ending inventory at March 31. So we have the number of units on hand of each of the three products, we have the cost per unit, and then we have the market value per unit. So the next step is that we want to compare the cost per unit to the market value per unit to determine the unit lower of cost or market. So with the units of X, our cost was 100, the market is 90, so the unit lower of cost or market is going to be the 90. With the units of Y, we paid 125, the market is 140, it's higher, so the lower of cost or market is the cost of 125. And then for our units of Z, we have 300 units on hand, we paid $80 each for them, the market is 60. So lower of cost or market for Z is going to be the 60. So I've made a table here where I have determined the total cost and the total lower of cost or market value. So we had 200 units on hand that we paid 100 for. So the cost of the X units is 10,000. The Y units, we have 250 on hand that we paid 125 for. So the cost for those units is 31,250, and then for the 300 units of Z that we have on hand, cost was 80, and so that means that the total cost is 24,000. So if we add up those three numbers, we get 65,250. So if we were to look in our inventory account right now, the balance in our inventory account reflecting the cost is 65,250. When we apply the lower of cost or market for the units of X, we have 200 units, LCM is 90, so the total LCM for those units is 9,000. For the units of Y, we have 250, LCM for those units is 125, so 250 times 125 is 31,250. And then for our 300 units of Z, LCM is 60, 300 times 60 is 1,800. So we have applied LCM to each of those inventory items, and the total LCM is 58,250. So essentially, our inventory account balance right now is 65,250. The LCM value is 58,250. We don't want to report it at 65,250. We want to report it at 58,250. So that's a $7,000 difference. So we need to make a $7,000 write-down of our inventory, and so we're going to charge that decline in value to cost of goods sold. So the additional adjusting entry that we would need to make for our inventory to write down our goods to market value is a debit to cost of goods sold and a credit to inventory of $7,000. So with that entry, we are increasing cost of goods sold by $7,000 and we are decreasing our inventory account by $7,000. So that's not great matching. Cost of goods sold should be the cost of the units that we sold, and in fact this is a decline in value for the units that we didn't sell. If it is a material amount, you would charge it to a loss account, but typically you're just going to charge it to cost of goods sold.